Alright, welcome back to my YouTube channel, where we talk about all the good stuff like finance, investing, and trading stocks the right way. I'm here to share real-world methods and ideas that help you build the right understanding of the market, not just theory, but what actually works. We'll go over investing strategies, trading mindsets, and practical lessons that schools never really teach. This will be a series of videos, and this is going to be the first one. Each video will go a little deeper, starting from the most basic ideas and moving toward more advanced ones. And trust me, I've got other things prepared for you. You'll know what I mean once you see them. If you want to take control of your money, grow your wealth, and trade smarter, not harder, you're in the right place. So today, we're going to start simple and talk a bit about regular investing. Yeah, about the strategy of dollar cost, averaging in the US, how to calculate it, how to execute it, and some of the standards for choosing where to invest. So why are we talking about this strategy? Because I found that, actually, from the perspective of active investing, it's not necessarily suitable for most people. Of course, active investing has its own fun, but regular investing also has its own long-term stability. So, I want to talk with everyone about the basic concept of regular investing, how to calculate it, which calculators you can use, and also show you some historical returns, as well as how to actually execute this strategy right now. This is actually quite useful for friends who have long-term planning. And later, when I show you the returns, you'll see that they're actually not bad. In fact, overall, it's quite simple and easy to carry out. Alright, let's jump right into today's topic. So, first of all, what exactly is the dollar cost averaging strategy? Basically, it's a simple plan where you invest the same amount of money each time, no matter what the market is doing. It's easy to stick to. And in terms of both returns and stability, it tends to work out better over the long run. Alright, let's look at the basic concept. Usually we're talking about a pretty long period of time, generally more than 5 years. Some people also make 3-year plans. But the characteristic of DCA is that the longer the time, the better and more stable the effect. So here, I'm referring to when you have a plan longer than 5 years. For example, if you're 10 years away from retirement, you can totally start doing DCA now. Even if you've got 20 years or 30 years, you can still do DCA as long as your finances allow. So typically, over more than 5 years, you invest at fixed intervals, like every month or every week, always at the same time. For example, maybe you choose the first day of each month or every Monday, and you invest a fixed amount, say, each time you invest $100 or $1,000 or $5,000 into stocks. The amount is totally up to your financial situation. For example, if you have a stable salary, a steady cash flow every month, and that money is your extra money, meaning not the money you need for living expenses. Don't squeeze your necessary spending to do DCA. We really shouldn't do that, because investment shouldn't make your life harder. The long-term idea behind DCA is to create a financial plan that helps you accumulate and grow wealth over time. If your life is already comfortable, then yes, consider investing some of your extra money. But you should prioritize maintaining your lifestyle, not rely on investing to cover your living costs. That's not right. Investment should always be done with extra money. And extra money means money you can set aside and not touch. Generally speaking, a family's money can be divided into 3 main parts. First, the basic living expenses. Second, the flexible spending, like money you can use for investments, or optional spending, like travel. And third, that's the money you don't touch under any circumstance, save for emergencies or accidents. So, DCA belongs to the part of money that's meant to preserve and grow value. Money that, if you lose it temporarily, it's fine, and even if it grows, you're not planning to take it out soon. That's what we'd call a complete investment plan. Alright. So, for a period over 5 years, you can choose monthly, weekly, or even quarterly intervals, or even yearly. Though, monthly or weekly are the most common. Since some people get paid monthly, others weekly or bi-weekly. So, the strategy sounds really simple. You buy at a fixed time for a fixed amount, right? So what are the advantages? The biggest advantage is that it helps you build a good disciplined investing habit, because sometimes you just can't resist spending your investment money elsewhere. You've got some cash in your pocket, and you think, should I go take a trip? Even though you didn't plan one, or maybe, should I buy a new phone, a new computer, a new car? This is the kind of money you don't really need to spend, but just feel itchy holding it. A lot of people feel uncomfortable just holding cash. They feel like they have to spend it. So when you set up a DCA plan, you're giving that money a purpose. It helps you develop financial discipline and achieve long-term goals. That's an investing habit, and it really tests people's discipline. Because only when you're disciplined do you really plan for the future, right? Another advantage is that it makes you stop timing the market. Not timing means you're not afraid of missing out, and you're not afraid of short-term drops either. You're not stressed about not earning enough, and you're not panicking about paper losses during declines. It reduces your anxiety about holding positions. Because, honestly, trying to predict the exact market top or bottom, like selling at the very top and buying at the very bottom, is almost impossible. Maybe occasionally you'll catch a relative high or low, but not consistently. If you chase that perfection, you'll definitely be disappointed, because it's simply not doable, not even for professionals. So the discipline of DCA ensures you won't care too much about short-term ups and downs, since you've already set a long-term plan and goal. Also, in behavioral finance, there's a well-known concept. Most people are naturally loss-averse. They react more strongly to losing money than to gaining it. Meaning, when you lose money, the pain is stronger than the joy of earning the same amount. So DCA also helps reduce that emotional anxiety because you stop caring about short-term fluctuations. You know that in the long run, DCA has a very high probability of making money. For us stocks, it's practically a 100% success rate. Historically, the indexes always go up in the long term. So the outcome is certain. The only uncertainty is how much you'll make, not whether you'll lose outright. That's about the benefits of DCA. Now, let's talk about choosing what to invest in. Very simple, straightforward, no room for debate. For us stock DCA. I'm only talking about the US market here, not others. The DCA strategy I'm talking about applies to the US market only. If you try it in other markets, you'll find some of them simply don't work. No matter what you do, you'll just get cut, because those markets function differently. But the US market is different. The US stock market is a mechanism for resource redistribution, not just financing. That's why you can see solid long-term growth. And also, why does the US index keep rising? Because every year, the bad companies are removed from the index, from the S&P and the NASDAQ, and stronger companies replace them. So it's always improving. That's why it's hard for the whole market to be in a long-term bear state unless the entire US economy collapses outright. So you basically only need to choose between two major ETFs, just two, SPY and QQQ. Don't bother with the others. These two have been around for a long time, have great liquidity, and are run by big, reliable institutions. Some people might ask, what about VOO? Well, that's almost the same as SPY, but the liquidity is a bit lower. Since you're doing a long-term plan, you should choose the most stable option, right? Avoid smaller or newer ETFs, those launched within the last 3 years, or leveraged or inverse ETFs. All of those have hidden decay. They're not suitable for long-term DCA because the longer you hold, the more they erode value due to daily rebalancing. And don't DCA single stocks either, because the whole point of DCA is diversification. If you pick one company, like say Nvidia, even though it's doing great now, it still carries company-specific risk. Back in 2000, many stocks dropped over 90% and still hasn't recovered its old high, even though it used to be as hyped as Nvidia is today. So, that's why DCA should stick to indexes. They adjust themselves, spreading risk automatically outright. Now about execution, many compliant brokers already offer automatic DCA features. Once you set it up, they'll deduct funds automatically at your chosen schedule. If your broker doesn't, you can always do it manually. Just log in on your chosen day each month and buy at market price. Don't overthink it. Don't try to time highs or lows, because with monthly investing, a tiny difference of 0.5% or even a full percent doesn't matter. Over years of compounding, and if you want to calculate historical returns, there are plenty of DCA calculators online. Just set the time frame, the amount, and the asset like SPY or QQQ, and you can see your potential returns. For example, if you had invested $1,000 every month in SPY for 10 years from 2014 to 2024, the total return would be a bit over 100%, meaning your money would have doubled with an average annual growth around 7.5%. And if you had done the same with QQQ, your annualized return would have been around 11% and your total return close to 185%, almost tripling your money in 10 years. So, if you can handle a bit more volatility, QQQ gives you higher returns. If you want more stability, SPY is the safer choice. Either way, DCA works. It's simple, disciplined, and it keeps you calm through all market conditions. That's everything I've got for you today. If you found this video helpful, make sure to like it, subscribe, and turn on the notification bell so you don't miss the next one. There's plenty more coming your way, so stay tuned, and I'll see you in the next video.